So today for myself, we're going to be covering strategies for a high volatility market. So kind of a perfect topic for the current market that we find ourselves in. So if you guys have any questions, just let's try to save them as much as we can to the end. I'm going to just cover a couple of things to look at so that you understand if something is in a high volatility or a low volatility environment. And then we'll talk about different strategies that work well in that type of environment. So let's go ahead and dive in. So what is considered high volatility? Well, this is the very first question you need to ask yourself, right? Before you really even consider putting on a trade, one of the most important inputs, and this is worth writing down, the most important inputs to the price of your option, whether it's a call or a put, doesn't matter, is going to be implied vol. All right, so the question is, how do we know whether implied vol is high, medium, or low? And that will dictate what strategy we choose. Different volatility levels work better with different strategies. So here's just a rule of thumb. Of course, all of this will be a rule of thumb, but I think it's a good one to go ahead and start following. So if your implied volatility, I'm just going to use an IV from now on. I think we can all understand what that means. If your IV is between, let's say 0, and that'll be rare, but 0 to 25%, you typically want to buy options. That's low. Let me go ahead and mark that. That's relatively low. If the IV is, let's say, from about 25 to, let's say, about 60%, you can do either one. You can buy or you can sell. And lastly, if your IV is 60 to 100+%, typically you want to buy, or typically you want to sell. Now, keep in mind, every product will have its own IV, right? So that's an important thing to understand. Every product, I have to stop doing that. Every product will have its own IV, let's call it personality, right? So, for example, if you were to see Roku, for example, usually high implied volatility stock. If you were to see Roku with a IV 60 to 100, that means something different than if you were to see utilities at that level, right? If you see utilities at that level, even if they're the exact same, let's just use an example. Let's say that utilities and Roku both have an IV or an implied volatility of about 80%. You know that the implied volatility for utilities is actually significantly higher, even though the number is the same, because Roku has a higher volatility overall. So if they're both trading 80, utilities are going to have a more mispriced IV in that situation, right? So the main thing that you want to start off by doing, understand what your IV is, and that will dictate your strategy. So how do you understand what your IV is? Well, let's go over here. So this is just a pretty common options chain on Tastyworks here, and you can get your implied volatility numbers over here, right? So you see how for Friday, or actually for today, the implied vol is 258% on SPY. That's very, 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 very high. This is not common for this name, but check out what the kind of the average IV is here, right? You can just kind of eyeball it. You know, what would we say the average IV is for the next, 40 days or so? Well, the lowest number I see is 42. The highest number I see is about 84, and most of them are between 60 to 70. So I think it's pretty safe to say that IV here for SPY, regardless of whether you go out, up to 40 days or so, roughly between 60 to 70. Right. Now, based on our previous set of notes, if the implied vol here on SPY is 60 to 70%, for a wide swath of different expirations, what do we want to be doing here? Do we want to be buying options, or do we want to be more sided towards selling options? Okay. Yep. Randy, you got it. We want to be typically selling more a premium here, right? It's on the higher end, right? Keep in mind what our notes say. Our notes say that 60 to 100% plus, we typically want to sell options. Now, here's the thing, guys. We find ourselves in a very interesting market right now. The strategies that will go with the implied volatility of 60 to 70, selling that volatility, also implies that things will calm down a little bit, right? So keep in mind, anytime that you're selling premium or you're selling IV, and we'll talk about the different strategies to do that next, you are essentially betting that implied volatility will go lower. Right, the trade will benefit most if the IV goes lower, which it typically does over a long sample size. If the IV goes higher, then you want to be doing more of a different strategy for that. But let's just work under the rule of thumb that when IV is relatively high, we do want to be typically selling options. Right. So immediately we look at SPY, we say, okay, the IV here is about 60 to 70%. That means that by our rule of thumb, we want to be on the sell side of premium. So now that we've kind of isolated a product and we've isolated a strategy, meaning selling premium, what does that actually look like? Let's go there next. So let's just go out to April 17th here. Right, April 17th is, and I apologize, I know the screen's a little small here, but April 17th is just a monthly expiration, kind of gives us a good idea as to where to go ahead and start setting up this type of idea. So because we want to be selling premium, because the IV is, 60 to 70% on this product, you've got a couple of different choices, right? So I'm going to use the options all to the long side. Keep in mind, you can do the exact same strategy to the other side, right? But I just think it's going to be easier to just show you the long side. So the first strategy that works well in this type of environment, which is primarily a premium selling market, is doing something like a short put vertical, right? So in this instance, the spot price right now on SPY, 225 is the at the money call or the at the money put. And so we could set up something like this, right? Now, with this type of strategy here, this is basically a put credit spread. You're going to see that we're selling the 225 put, which is the at the money put. You can do the 226 as well. We're selling the 225, and then we're buying the 220 as protection. Because we're selling this one, and we're buying this one, it leaves us with a slightly negative vega here, right? So our vega will be slightly negative, meaning that essentially we've sold premium. If the IV starts to come into something more reasonable, like 50 or 40, that will actually benefit us. Also, you can see your Greeks down here. By doing it as a short put vertical, that's taking in a credit, so basically a put credit spread, you can see that your delta's actually positive, right? So it's a bullish trade, and you can see that your theta is actually negative, right? So that benefits the trade as well. So this is the easiest one to consider. Essentially, you're just selling the at the money, or maybe sometimes even in the money put, and looking to set up protection that way. So that's kind of the most basic one that we would do, and I think it's a decent one for almost every market, especially in a high volatility environment. Now, let's say that you wanted to do something similar, but you don't want as much direction, right? So here, with this particular trade, even though it's only 5 wide, which is really small in this market, the expected move is 27, and we're only 5 wide, which is pretty small. Let's say that instead you wanted to take even less risk, right? Let's say that you like the market, but you want to take less risk than that. Well, another option for you, and this is the second strategy that you could do, keep in mind, I'm doing all the examples as long trades. So the other one would be something like the long call butterfly. So let's go ahead and set something up like that. So in that instance, let's just do it at the money. So we'll do it at the money. We'll buy the 225. We will, I'm just going to choose a random one here. Let's sell the let's just do a 10 wide. 225, 235, 245. I know that's not giving me the delta, the strikes I want. Let's go bigger. Okay, this will work. Alrighty, so in this instance, we've created a different type of bullish trade. Mind you, the first trade we made was bullish. The second trade we made is still bullish. It's just structured a little bit differently. So the first trade has a little bit more directional kick. It's a type of trade, put credit spread, that you would do in a high volatility environment where you have more of a directional edge, right? If you have a squeeze or you have a setup that you think is going to break higher or lower, but in this case higher, then putting that directional edge in your favor by doing a put credit spread makes sense. Let's say that you are a little bit more unsure, however, or you just don't think it'll happen that quickly. Let's say that you think it'll happen more slowly. Well, in that instance, the call butterfly makes some sense. So here we've set up a call butterfly. 225 is our primary long call. Right, so we're buying the 225 call, and this is kind of the star of our trade. We're financing that call. We're financing that call with the sell of two of the 240s. Right, so you see how the 240 is going for roughly $7 here. We sell two of those. Right, so we basically take in $14, and that covers the cost of this one. And then lastly, we have the 255 down here as protection, right? So what are we saying with this type of trade? We're saying with this type of trade that the SPY, until expiration, although it doesn't have to go until expiration, you could definitely take it off as a day trade or whatever you want. But these types of trades, the butterflies, work best if you're able to hold them because of the decay of these two. So what we're saying with this trade is we're long the 225. This is the star of the show. We're short two of the 240s to finance that one. And then we bought a 255 as protection. So anywhere between 225 to about 255 is okay. The closer that we can get it to 240, the better, right? This trade works perfectly if we close on the day of expiration 1 penny below the short strike. Why is that? Well, because if we were to close at 239.99, this 225 put or 225 call would be worth $14.99, right? And if we were to close at 239.99, these two 240 puts that we sold are worthless. So we get to keep the credit. So that's good. And then lastly, this 255 that we bought as protection is also worthless. So at the end of the day, best case scenario, it's 15 wide. And so you have a butterfly that's 15 wide, 15 from here to here, and 15 from here to here. The most you can make is $15 on this, right? If the perfect scenario plays out where it closes at 239.99 or 240, I guess. And the most you could lose is the debit paid. So the most that I could lose on this trade would be about $3. Now, why do we like this type of strategy? Well, notice that compared to the put credit spread, the deltas here, it's about 1/5 of the deltas, right? So if you guys recall on the put credit spread, the delta was 5. Here, the delta is 1, right? So you've reduced your directional exposure by about 80%. Pretty significant. What else have you done here? Well, because you sold two of the 240s, this trade benefits if IV comes in, right? If I were to set up this trade and fire it off, you would see that the Vega would be negative again, right? So again, this type of trade benefits if the IV, notice the IV here is 66. Let's say that goes down to 56. That benefits this fly. So that works well for this type of high volatility. And lastly, you can see the theta here is actually much more positive than it was on the put credit spread. So a couple of advantages and disadvantages, right? If you are more directional, then you want to be in the put credit spread because it's going to give you that directional kick, and it gives you the IV, and it gives you some theta. If you're less directional and you're more thinking it can move upward, but maybe kind of slowly, kind of choppy, but you think it's going up, then doing the butterfly gives you less directional exposure, gives you a lot more theta, so you'll get a lot more coverage, if you will, from the passage of time, and you'll get bigger vega, right? So very similar strategies there. The one thing to understand for anyone who might be very new to these is if it goes below 225 or above 255 is when the trade starts to really not work, right? So ideally with the butterfly, you want to get as close as possible to the center strike, ideally without going over, but you definitely don't want to go outside of your wings. So just something to keep in mind. And this one does have risk on either end of the wing. That is something you should know. The other strategy that you could use here is going to be something like an iron condor. Right now, with the iron condor, we'll go ahead and set one up here. And you want to be short an iron condor. Let's do 220, and let's do it. Let's do it 10 wide. And then we'll do 240, and we'll do 10 wide. And then we'll look at our Greeks here. I tell you what, I don't like the negative deltas there. Let's go up a bit. 40, 230. All right, let's keep going with it. All right. So I had to play around with the numbers a little bit to get the Greeks right. But if you set up an iron condor here, that's 230 by 250, 10 wide, you can get the very comparable deltas or Greeks. So notice with this one, your theta has actually gone up. Right, so the iron condor here, it's the third strategy that we've talked about. It's going to give you probably the biggest theta out of the bunch. So with the iron condor, instead of saying that you have a directional bias, for example, in this case, we're saying that it's going to stay between 230 and 250, right? And so essentially the iron condor will make money as long as price chops around between these two levels. As long as it stays between 230 and 250, you'll continue to get decay on this contract and this contract, which is exactly what you want, right? We're selling premium here. So we sold the 230 put, we bought the 250 call, or excuse me, we sold the 250 call, and we're looking for it to chop around, which will decrease the prices of these as time passes, right? And so you can tell here in your Greeks, you get positive theta, and you get a slightly positive delta here. Right, so the difference with this one and the fly is they're very similar. They're going to be pretty similar. This one relies less on a center strike and gives you more playability between the zone, right? So the other one that we did was what, centered around 240, I believe. This one doesn't care as much about the center strike. As long as it hangs out between 230 and 250, you'll continue to get the decay, and you can pocket the premium that way. So far we've talked about put credit spreads, and you can do call credit spreads as well. Keep in mind, anything that we've shown you so far, you can do on either side. So I've shown you nothing but bullish examples just because they're easier to talk about, but you could easily flip it and do it as a bearish example, and the same thing would apply. So let's let's see, anything else? Well, let me show you a straddle. Yeah, we'll go ahead and close with this one. So with the butterfly, we could talk about iron flies. I don't want to get too into the weeds on that one. Basically, they act very similar to butterflies. So if you understand butterflies, another concept that you can use is iron flies. We won't get into that. They're very, very similar. But we've talked about credit verticals. We've talked about butterflies. We talked about iron condors. These are all three of these strategies will benefit you the most if you can get that IV, currently at 66%. You can see that in the top right corner. If you can get that IV to come in, that will make the trade work perfectly, because if you can get the direction right, if you can get the passage of time, and you can get the IV to come in, then you've hit all three of your major Greeks, and that trade would work out very nicely. But let's say that you're in a high volatility environment and you think it might actually go higher, right? I'm just going to show you one more strategy you can use for that. If you think a volatility can go higher, right? Like let's say that it's at 66% right now, you think it could actually go up to 70, 80%, then you typically don't want to be doing these strategies, right? So you have to trust your read on IV as well. But let's say that you think it can go higher, but you don't really want to bet on a direction. One thing you could do is just a straddle. And with a straddle, you're basically selling, or you're basically buying two different options here. Now, keep in mind, this one will only work if IV goes higher, right? So you want to be very, very mindful of this one, but I do want to put it in your bucket. And essentially, with a straddle, we are buying both the put and the call, usually at the money, right? So you see here how we're buying both the 222 put, or the 222 call, and the 222 put. What does that do? Well, won't they actually cancel each other out? Kind of. You can see here the deltas are actually positive here, so it is a bullish bet on the deltas. But primarily when you do something like this, the straddle, you're betting that implied volatility goes up. And in effect, you don't really care about direction. That's the kind of the cool thing about this particular strategy. So if you get the IV over here, 66%, let's say you had a crystal ball, you knew it was going to go to 80, you could do a straddle, not worry about the direction, and just bet that by the increase in volatility, the fact that you're long both at the money call and put, the IV will help you on both, and you can play volatility that way. Right. So just real quick again, the first strategy that we covered, and maybe I should write it down. So let me give you guys some notes here to take a screenshot of. First strategy, put or call credit spread. Advantages. Works well in high IV. Will work well with passage of time. Gives more directional kick than the other strategies. Second strategy, call or put butterfly. Advantages. Works well in high IV. Well, I guess I'm going to repeat it. Will work even better. I'll put that. Let me put usually, because you can set it up so that it doesn't, but usually it will. Neutral direction. Third strategy was an iron condor, iron fly, same thing basically, very similar. Advantages. Well, the advantages are all sounding the same now, huh? It works well in high IV. Will work best with passage of time. and allows for almost completely neutral, if you set it up correctly, directional bias. Right. So you see how all these trade strategies, they're basically very similar. They just will give you a little bit more kick in terms of direction. Now, the fourth one that we talked about is a straddle, long straddle. Works with increase in IV. Directionally agnostic. Alrighty. So I think that's what we got. Let me see if I missed anything else here. I'm just going to go ahead and put a little bit more notes here. The general idea of a high implied volatility environment. And also keep in mind that high IV, or high implied volatility, will increase, and I maybe already talked about it, but will increase the cost of all options, right? And so the idea behind that is when options prices are high, we typically want to be selling them. Alrighty, so that's what I got for you guys. Let me know if you have any questions. We wanted to go ahead and just put it towards the end of the day or the end of the session in terms of a Q&A. If you guys have any questions for me, let me know. If you guys would like for me to set anything up or would like for any more examples, happy to help. Just going to check in on the market here. Yeah, so for today, for example, like an iron condor today, I did the open with you guys this morning and I said, it looks kind of like it's going to be a choppy day until the vote. By my read, the vote should have come out. I think they maybe pushed it back till after the bell. But you can see here that just kind of a real life example to cover with the group. Let's just say hypothetically you had done an iron condor from 2350, 2150, right? Pretty wide, very wide condor, but you're basically betting that it stays between those yellow lines. As long as it stays between those yellow lines, and the longer that it does so, the better it is for your condor, because the calls here will be losing value. So you can see how, in a practical example, it makes a lot of sense. Also, you can see that based on some of the trades that I sent out today, we also did them as butterflies, right? So I did a TLT butterfly with you guys, and I also did a gold butterfly. So let's actually just take a quick look at those examples. If you have any questions, let me know. If I don't get any questions, we'll go ahead and call it a session. So for example, I'm going to pull up TLT here. Now, TLT, keep in mind, TLT is government bonds, but you see how it's kind of hitting our benchmark here? For today or for this week, the IV 71. So we do want to be on the sell side typically. For next week, the IV is right around 60, and then it kind of gets in the middle, right? You see how it kind of goes into the 50s? So with the 50s, keep in mind, we could do either one. Usually when they get 60 plus is when we really want to side towards premium selling. But with 50, we could buy or sell. Because I did the butterfly, and I know that IV for TLT is historically high, it is basically betting that the IV for this expiration series will come down and decrease the cost or the value of the ones that I sold, which covers the ones that I'm long. So I end up with a net profit, even if just nothing else happens other than IV coming in. So also, it's a very crazy market. I don't want to take outsized directional exposure. So doing it as a butterfly also kind of gives me that happy medium, right? It's not quite a put credit spread where it has a lot of directional exposure, but it's not quite a condor where it doesn't have a lot of where it almost is totally neutral, right? So the butterfly is kind of that happy medium between the two. And that's why we did it. That's why we structured it that way. So Frankie, as a general rule, when designing a trade around selling premium, you construct them in a way for the price to move into your short sell, short strike. Yeah, Frankie, what I typically would recommend is putting your short strike on a butterfly, either A, at a key psychological level, like 150, 200, 100, things like that, or putting it at resistance. I can actually give you an example here with TDoc. So we have a butterfly from last week with TDoc, and now, if you had told me it was going to move like $20 or whatever it's up today, then obviously you want to be something more directional. But I think we're in good shape. So TDoc here is a good example, right? So anyone remember what our butterfly is on this one? We have the 140, 170, 200 fly here. Now, why did I choose 170 as the center strike? Well, I ran a Fibonacci from that high to this low, and it gives you some extension targets, right? So this major swing here, you can get your extension targets that way. And you can see here that if you get your extension targets, your first extension target, the 1272, comes in at 167.82. Right. And I'm just looking at that to be a point of resistance. You can see that today the high was 168. The target was 167.82. It went above the high by about 18 cents, and now it's trading about $6 off the high. That's perfectly fine for our butterfly. That's what we want. But in terms of structuring the trade, Frankie, what I did here is just found where I think is resistance or where a target would be, 170, put the center strike there, and then work with the fly or the wings to kind of capture what I think is a good range. And so that's what the trade will end up looking like. So if you could find resistance, whether it be this type of resistance or whether it's just a previous high, for example, previous low, I usually will recommend putting your center strike there because that increases the probability that it expires worthless, which is what you want, ideally. Can I explain the third strategy? Is a butterfly a debit? Yes, Roberto. The butterfly would be a debit. I don't know if the butterfly was a third strategy, though. I think if you're talking about the third strategy, the condor would be a credit, usually. Right? And keep in mind, whenever you take in a credit, you're hoping that the credit goes to zero, right? Basically. So you take in, let's say, $1, $2, $5, whatever the number is. And ideally, you want it to expire completely worthless and you keep the entire credit. So the idea behind the condor is essentially, I'll just use TDoc here again. The idea with the condor, let's say that I had done a 170, 140 condor, right? As long as it trades between 170 and 140 and doesn't exceed it, right? Because keep in mind, you on a condor, you lose on either end, similar to a butterfly. As long as it doesn't exceed it and trades into this zone, you will make money with the passage of time and the decay of the premium as it trades sideways. So with the Condor, you're typically going to be selling the Condor, and you're going to be taking in a credit. With the put credit spread or the call credit spread, the first strategy, you're always going to be taking in a credit. With the Butterfly, however, you're actually going to be paying a debit. Keep in mind, with the Butterfly, the center strike is only to finance the long strike. Buying, selling, and credit requires more capital. Yeah, DK, that can be the case. So if you do anything that takes in a credit, it might eat up more buying power. So just something to be aware of. Of course, you can always adjust for that. Make it a little bit more narrow, things like that. But you're right; it will eat up typically a little bit more buying power. Does the number of days to expiration change any of these strategies? Yes. It will make them faster or slower. So how can I show you this? I tell you what, let's just do it on the gold Butterfly that I did. Or actually, I'll do it on TLT. I'll just keep it consistent. So TLT, if I set up the trade over here on Tasty, even though I did it on Toss, I'll set up on Tasty. This is the trade what's the trade that I have? 160, 170, 180? What did I do? 160, 175, 190. All right. So this is the trade that I sent out earlier. Actually, I bought another one. So it came back to my entry, and I picked up another one. But this is the trade I sent out earlier. This is a 15 wide Butterfly on TLT. Basically, this is the star of the show. Keep in mind, the 160 is really what we want to push this one. We finance it by selling two of these. And ideally, it lands at like 174.99, right? That would be just perfect, because that would be worthless. We get to keep the credit. That one's worthless. We don't care. And then this one at 175 would be worth $15, 160 call. So one thing I want you to notice here is look at your Greeks, right? So let me just get my bearings here. I didn't do it for this expiration. I did it for this expiration. So this is the monthly, right? This is the monthly. All right. So this is the exact trade I sent out with you guys. Notice that your deltas here are 13 and your theta is 3.3, right? So I'm just going to write that down. 13.11, 3.37 is theta. Now, let's say that you go shorter term expiration. What will that do to this Butterfly? So let's go 1 week earlier. Let's push it. Let's do 2 weeks just to make it more dramatic. So you see here how by making it shorter dated, instead of going out till April 17th, if we were to just do this for April 3rd, and maybe I should have done this one, to be honest. Now that I'm looking at it, I think this is better. If we push up the expiration, do you see how the delta, which was 13, is now almost 20? And the theta, which was 3.3, is now almost 6.5? So basically by making it shorter dated, by giving yourself less time, you're increasing your deltas and your thetas, typically. Right? Just another rule of thumb. So what are you doing? Well, you're just torquing the idea. You're making it so that it directionally has more kick, and time-wise it has more kick, which kind of makes sense, right? You have less time for it to work out. If you have less time, that means every Greek in your chain will be a little bit more torqued, if you will, or higher. And obviously, if you do the exact same thing the other way, let's go further dated. Just think of it this way. If you do set up the trade and you go shorter dated, it's going to move faster. If we push it back from April 17th, and let's say we go to March 15th, you can see here that your delta, which was originally 13, is now 7, and your theta, which was originally 3.3, is now 1.7. So by pushing it back, we make it slower, and we make the ride slower, essentially. By pushing it forward, we make the ride faster. So the TLT example is shorter expiration is better. Good phrasing there, JD. The question is, what do you want to do, right? Because to say that it's better is it's not better for everyone, right? Because let's say it just takes a little bit longer, and maybe shorter term isn't better, right? But what I can tell you is that shorter term has more torque, right? So you're going to get more torque for every penny that the stock moves, right? And if you don't want that much speed, you just pull back and you go to a later expiration. So you can crank up the speed by going shorter dated. You can pull back the speed by going longer dated. The strategy remains the same. Just the movement of the contracts will be slower or faster depending on what strike you choose or what expiration you choose. In terms of if it's better, well, it depends on what you're trying to do. If you think that TLT can quickly get up to 175 in the next 2 weeks, but it's not going to break it, then yeah, of course, you want to go shorter dated because you're going to get that kick, right? Anytime that you have a better read on a product, go shorter dated because you want to torque the idea. But if you're unsure, then it's usually better to maybe slow it down a little bit, and that gives you a little bit more flexibility. So I wouldn't say one is better or not. It just depends on how fast you want to drive down the road. What do you think about buying both a put fly and a call fly for something like this week on Apple? I think that's fine, JTrades. We will typically do that in for earnings, right? So like that's a strategy that Danielle likes to use for earnings, is basically betting that it's going to what it ends up looking like I'm just going to put an example here. Let's say that you were to buy an upside fly, 2340, 2380, and let's say you were to do, let's just put another middle strike here just so it looks like a fly. And then you were to do another fly down here, right? And basically you're betting on a big directional move in one way or the other. But you're direction agnostic, right? Because if it goes up, you're okay. If it goes down, you're okay because you have butterflies on both ends. I don't mind the strategy at all. What I typically will say is it's usually better to go out of the money on both, right? That keeps them cheap. And if you go out of the money on both and one hits, the gain on one will typically cover the cost of the other. However, just understand if you're kind of new to this, or if you're just getting started or whatever, doing double butterflies like this, while there is merit to it, can open up another can of worms, right? Because it's entirely possible. Keep in mind the butterfly has risk to the top side and the bottom side, right? So the worst case scenario is you set up a fly on both ends and it somehow blows through the bottom of the lower one, and then they both are worthless, right? You don't want that. But if you're kind of trying to take a directional shot on both ends, I don't mind it. I don't mind it. Just be very aware that the more moving pieces you have, usually the more complex it is. Also, keep this in mind. If you're betting on a big move, are you really betting on IV compression, right? Because IV compression, implied volatility compression, looks like this. And if you're setting up a fly that works up here or way down here, are you really betting on that? Well, maybe not so much, because you're actually betting on a bigger move. So in that instance, maybe a straddle would work best, which is the fourth strategy that we discussed. So I don't mind it. I've seen Danielle do it a lot and do it successfully, but just be aware it opens up more potential issues if you do it wrong. Can you explain the difference between a straddle and a strangle? Sure. So that's kind of what they end up looking like. I typically would go with the straddle, just out of personal preference. The difference is they're very similar, right? You can see that they look very similar. They're very similar ideas, and they're both expressions on implied volatility increasing, right? So and keep in mind, maybe this is the time for. We probably will cover this again tomorrow in the low volatility session. But in this instance, if you're betting on IV increasing and you're directionally agnostic, you could do either one. You can see here again that they look very, very similar. The only difference is the strangle has a wider point because you have two different strikes versus a singular strike with the straddle, right? So you're going to get a little bit more kick from the from the straddle, I believe. But the only difference really between the two, from a strategy point of view, they're very similar. The only difference is you'll have one common strike price here, and you'll have two over here. They're very, very similar, though. And they're both betting on the price not staying where it is. You see how if it stays right where it is where you lose, right? So you want this thing to shoot out in either direction. So just for the person that asked about double butterflies, this is kind of what it sounds like you're talking about. So maybe look into that one.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me over.